Imagine you're staring at a control dashboard for your business, right?
Right.
And a red light flashes. So
Okay.
you see the problem, you point to it, you tell your engineers, fix it, and the light turns green.
Because business is supposed to be binary.
Exactly.
Yeah.
Broken or not broken,
Yeah.
you diagnose, you execute, and you move on.
Yeah.
But what if I told you that in one of the largest, literally most fundamentally critical industries on the planet, that dashboard is it's entirely disconnected from reality.
Like the red lights are flashing, but the actual fire is...
The fire's burning in a completely different building.
And that fire is consuming just an astonishing amount of capital. I mean, we are looking at a literal hemorrhage of resources here.
It's wild. Welcome to the Innovation Unpacked Deep Dive, by the way. I'm so excited to get into this with you today because our mission is to unpack this massive, hidden economic black hole.
Yeah, and the grounding material for today's deep dive, which is this highly structured strategic dossier authored by Mike Boysen, it puts the baseline numbers in just stark, terrifying perspective.
Lay the numbers on us because they are staggering.
So the insurance industry is bleeding nearly $60 million in direct operational waste annually.
$60 million just in waste.
Just in waste. But... and this is the real shocker, the number that should honestly keep executives awake at night, is the $495 million in customer relationship value that is simply being stranded. Vaporized. Every single year.
I mean, $500 million in relationship value just evaporating. And it's all happening because of this massive architectural bottleneck that, unless you're deep in enterprise IT, almost nobody fully grasps.
No, they don't. And that's why we're unpacking the venture-proof analysis today, because it essentially tears down everything the industry believes it knows about customer experience.
Right. It forces us to confront this phenomenon they call the visibility lie.
The visibility lie.
Yeah, and I promise you, listening, by the time we finish this deep dive, you will never look at a frustrated customer service interaction the same way again.
You're going to start spotting this visibility lie everywhere. In your bank, your healthcare provider.
Our airline app. Oh, man, airlines are huge offenders.
Totally. But to truly grasp why insurers are suddenly in this full-blown existential panic mode about their software, we have to rewind.
Yeah, let's look at the historical context. Because there was this structural paradigm shift that completely destroyed their traditional fortress, right?
Exactly. For decades, the insurance ecosystem was arguably the most insulated industry on Earth.
Because the barriers to entry were just astronomically high?
Astronomically high. You needed massive capital reserves just to legally operate. The regulations were opaque, fragmented across state and national borders. So because of these incredibly high walls, carriers relied almost entirely on something called actuarial pricing advantages.
So an actuarial pricing advantage. I mean, that essentially means their only real competitive weapon was doing the risk math better than the other guy.
That's exactly it, doing the math better.
They had armies of actuaries calculating the exact statistical probability of, I don't know, a teenager crashing a red sports car. Or a hurricane hitting a very specific zip code in Florida.
Right, and if your math was a fraction of a percent more accurate than your competitors...
you won the market. You didn't need to be friendly. You didn't need a slick app. You just needed to be mathematically precise.
Precisely. They were insulated by the math, but that insulation has completely dissolved now. We have entered an era that the analysts in the venture-proof analysis term the endurance economy.
The endurance economy. I mean, that phrase alone just feels heavy.
It is heavy because the macroeconomic reality is heavy. You know, consumers are financially constrained. Disposable income is tight.
Extremely tight right now.
And simultaneously, we are seeing a dramatic rise in secondary perils. We aren't just talking about once-in-a-century hurricanes anymore.
Right. It's localized hailstorms destroying roofs across the Midwest.
Seasonal floods, urban wildfires, combine all of that with what they call social inflation.
Which is the trend of rising litigation costs, right?
Yeah. Right. Massive jury awards driving up claim severities. You have a perfect storm.
Which means premiums are skyrocketing for the average person. I mean, we've all seen our auto and home insurance renewals this year. The sticker shock is real.
It's very real. And when premiums go up that drastically, the customer's margin for error, like their tolerance for how they are treated by the carrier, it approaches zero.
If I'm paying you double what I paid 3 years ago, I expect premium treatment.
Exactly. And that shift in consumer expectation has moved the battleground entirely. The war is no longer won in the back office actuarial department. The battleground is now customer experience. CX.
So technology in the insurance sector is no longer viewed as just this administrative tool for cost reduction. It is frontline intelligence now.
It is the primary weapon for differentiation.
The capital flowing into this realization is staggering, though. When I read the figures on global insurance tech spending, I literally had to double-check the zero.
Oh, the numbers are massive.
The industry is projected to hit $173 billion in tech spending by 2026. And the insurtech sector alone, these are the nimble startups trying to eat the legacy carrier's lunch, they're scaling at a violent 52.7% compound annual growth rate.
Scaling at a violent rate. I like that phrasing.
They are projected to reach over $152 billion by 2030. Carriers are desperately trying to decouple their legacy mainframes from their customer-facing interfaces just to survive this wave.
They have to decouple because the benchmark has changed. A consumer isn't comparing State Farm to Allstate anymore.
No, they're comparing them to Amazon.
Amazon, Apple, Uber. When you can watch a $6 burrito travel 3 blocks on a real-time GPS map, you fundamentally cannot comprehend why an insurer can't tell you where your $50,000 settlement check is.
Oh, I love that visual. It brings to mind this analogy I was thinking about while reading the dossier.
Let's hear it.
Imagine the traditional insurance model as this heavily fortified medieval castle. Okay? For centuries, the lords of the castle, the actuaries, sat high up in the keep doing their complex math, completely protected by the thick walls of regulation. Right.
But suddenly they look out the window and realize the invading army isn't bringing siege engines to batter down the walls. The actual war is being fought down in the village marketplace. It's being fought on mobile phones and digital touchpoints. So the actuaries are safe in the tower, but they've already lost the village.
I mean, I understand the appeal of the castle analogy, but let's inject a heavy dose of pragmatism here.
Okay, hit me.
Realizing you need to fight in the marketplace is the easy part. Any CEO can look out the window and say, hey, we need a better app.
Right.
The problem is that the castle's entire infrastructure, the ledgers, the policies, the data, is carved into stone blocks that weigh 10 tons each. Actually moving an army of decades-old mainframe data into a sleek, real-time mobile app in the village square is a completely different, almost impossible reality.
Wait, so you're saying it's not a lack of vision? Like, they know they need modern customer experience, but they physically cannot build it. The technology they built their empires on is now their most catastrophic liability. This brings us to what the venture-proof analysis calls the legacy blind spot.
Let's unpack the legacy blind spot.
You have to understand the foundational architecture of these companies. These insurance mainframes are often built on ancient COBOL architecture.
COBOL. I've heard of it, but mostly in the context of, jokes about dinosaur programmers. I mean, this code was written before you or I were born.
Exactly. Common business-oriented language. It was designed in the late 1950s and 60s.
Yeah.
It was built for batch processing, meaning you put a bunch of punch cards or data in, and overnight, the mainframe churns through the math and spits out an updated ledger the next morning.
So it's not real time at all.
Not at all. It was never designed to be pinged thousands of times a second by a mobile app asking for real-time status updates.
So if a carrier wants to build an iPhone app where a user expects an instant update on their flooded basement, how do they even connect a 2024 smartphone to a 1970s mainframe?
Through enterprise-grade middleware and API integration platforms. Think of platforms like MuleSoft. They act as heavy-duty translators. Yeah. The modern app speaks one language, the COBOL mainframe speaks another, and MuleSoft sits in the middle, translating the requests back and forth.
Having a dedicated enterprise translator standing at the gate of the castle sounds incredibly expensive.
Oh, it is punishingly expensive. The economics of legacy integration are brutal.
Give me the numbers.
So MuleSoft, for instance, prices its services based on virtual cores, vCores, and total message volumes. A vCore is essentially a unit of computing power allocated to process these translations.
Okay, got it.
For a mid-market carrier, just the base subscription for enough vCores to keep the system running can range from $125,000 to $300,000 annually.
Wait, that's just the subscription fee? Not even the labor to set it up?
Just the baseline access.
Yeah.
When you factor in the first-year deployment, the total cost of ownership, it easily hits $350,000 to $600,000.
That is insane.
Furthermore, these enterprise contracts have annual escalation clauses built in, usually 5 to 8%. Your costs compound organically every single year, even if your customer base doesn't grow.
So you are just bleeding cash to keep the translator at the gate. And I'm assuming you need specialized humans to configure this translator?
Elite human capital. Solutions architects who possess the rare combination of understanding modern cloud architecture and ancient mainframe logic, they command massive premiums.
Like how much?
We are talking up to $340,000 in total compensation for a single architect.
Oh my God. And then because we are talking about financial services and personal data,
Right.
you have the regulatory layer on top of all of that.
The compliance friction is massive, specifically SOC2 Type 2 audits.
Right.
Because insurance handles highly sensitive personal and financial data, proving that the data is secure as it travels from the mainframe through the middleware to the mobile app is a monumental task.
I can imagine.
The dossier notes that complying with these audits requires diverting $75,000 to $150,000 worth of internal engineering labor away from actual product development.
So your best engineers aren't even building a better app?
No, they are taking screenshots of system configurations to hand to an auditor.
When you lay out the physics of it like that, it's no wonder they are paralyzed. They are spending millions of dollars and burning their top talent just trying to put a modern, shiny wrapper around a dinosaur.
Exactly.
And this dynamic immediately brings to mind the case study in the venture-proof analysis, Guidewire software. The ticker symbol is GWRE.
Guidewire is the ultimate proxy for this industry-wide friction. The dossier details their trajectory to illustrate what it calls the SaaS transition valley of death.
The SaaS transition valley of death. It sounds like a tech horror movie. Unpack what happened to them.
So Guidewire is essentially the premier provider of core back-end systems for property and casualty insurance. If you are a massive carrier, there is a very high probability you run on Guidewire. In 2018, they were flying high. They hit peak revenue growth of over 28%. But that growth was based on selling traditional, highly profitable on-premise software licenses.
On-premise, meaning they sell you the software on a disk, you install it on the giant clunky servers in your own basement, and you pay them a massive upfront fee.
Correct. Perpetual licenses. Highly lucrative upfront cash flow. But then consumer expectations shifted. The market demanded real-time APIs, cloud connectivity, and seamless integrations.
Right, the Amazon effect.
Exactly. So Guidewire realized that the on-premise model was doomed. They had to pivot to a SaaS model, software as a service hosted in the cloud.
And let me guess. When you shift a massive enterprise from charging huge upfront perpetual licenses to charging smaller monthly SaaS cloud subscriptions, your recognized revenue absolutely craters.
It crashes completely. Welcome to the Valley of Death. By 2021, Guidewire's revenue growth flatlined to a microscopic 0.13%.
Wow.
Think about that. The entire growth engine of the most important software provider in the insurance industry just stopped dead in its tracks.
Wait, really? Because migrating these massive, custom-built, heavily integrated on-premise mainframes to a standardized SaaS cloud model was so painful that the carriers just stalled, like they just stopped buying while they're trying to figure out the plumbing.
That is exactly what happened. The carriers balked at the sheer complexity of untangling their customized code. It took years to push through the valley.
So did they make it out?
They did. Now, by 2025, Guidewire re-accelerated to over 22% growth once the bulk of the transition was complete. This ultimately proves the cloud pivot was necessary and successful in the long run. But that multi-year microscopic growth stall illustrates the sheer physics-level friction of modernizing this industry.
Let me challenge the premise here, though.
Sure.
If a mid-market carrier looks at Guidewire's Valley of Death, and they look at the $340,000 architects, and they look at the MuleSoft fees, are they facing an actual extinction-level event if they just refuse to modernize the backend?
What do you mean?
Like, can't they just fake it? Can't they just build a really pretty web portal, wrap it around the 40-year-old mainframe, and pretend they are modern?
The market has tried that, and the analysis confirms it is a catastrophic failure.
Really?
If you merely wrap a batch processing mainframe in a modern user interface, you don't get a fast, modern app. You get a 30-second load time when a customer clicks a button for an instant quote.
30 seconds.
30 seconds. In an era where Google research shows that consumers will abandon a web page if it takes more than 3 seconds to load, 30 seconds is a death sentence.
Wow.
The middleware literally buckles under the weight of thousands of API calls, frantically trying to wake up a mainframe that was designed to only think once a day at midnight. You cannot fake real-time architecture.
The infrastructure buckles. The capital evaporates. But here is where the venture-proof analysis gets profoundly interesting to me.
How so?
The dossier steps back from the technology and asks a much more human question. What exactly is this failing technology failing to deliver to the policyholder?
This is the core insight of the entire dossier, and it completely shatters the industry's foundational assumption about human behavior.
When I read this section, it was a massive aha moment because the insurance industry fundamentally believes that customers want two things: faster payouts and empathetic customer service.
Yeah.
The carrier thinks if we just write the settlement check faster and have our call center agents use a sympathetic tone of voice, the customer will be happy and renew their policy.
But the analysis drops a total bombshell.
Payout speed is not the primary driver of trust. Visibility is the governing trust variable.
That point deserves intense focus. Visibility is the governing trust variable. The data in the analysis proves something completely counterintuitive.
Which is?
Customers will actively tolerate resolution times that are 40 to 60% longer, provided they have continuous, accurate visibility into where their claim actually is in the system.
It's what the dossier terms the visibility lie. Let's break this down. Because the carrier actually possesses incredibly rich, highly detailed data about your claim.
Deep inside that COBOL mainframe, they have 40 or more internal actuarial codes tracking the exact micro movements of your file.
But what does the customer see when they log into the app?
The customer sees an opaque black box. Or, arguably worse, they're subjected to confusing internal corporate jargon.
Right.
They log in and see a status that says photo review queue, or subrogation pending tier 3, or field adjuster reassignment.
Which means absolutely nothing to a homeowner standing in a living room filled with 2 feet of floodwater. It brings me back to the pizza tracker analogy, which is so simple but so effective.
It really is.
Consider this. I never call Domino's to scream at the teenager working the counter on a Friday night. Why? Because the app gives me total visibility. I can literally watch the digital bar move from prep to bake to out for delivery. I know exactly where my $15 pizza is.
Exactly.
But for a $50,000 roof repair after a Category 4 hurricane, I am left completely in the dark. I have 40 dimensions of mathematical truth sitting in an insurer's database, but I am projected a shadow.
That shadow, that darkness, creates what the dossier calls the quiet middle.
Unpack the quiet middle for us, because this fundamentally changes how executives should view customer churn.
Traditionally, carriers focus their attention and their panic on the loud complaints. They worry about the people screaming on the phone, about the final settlement amount being too low, or the initial claim denial.
The squeaky wheels.
Right. But the deepest, most irreparable damage to a customer's belief in the brand doesn't happen at the beginning or the end. It happens during the silent adjustment phases.
The waiting period.
Precisely. The inspection scheduling, the peer review queues, the administrative handoffs between departments. These are the phases where the customer has zero visibility.
Yeah.
They don't know what is happening, they don't know what is expected of them, and they just sit there waiting. The dossier reveals that this is the moment when they silently decide to churn.
No.
They don't call to complain, they don't scream at a manager, they just quietly resolve to take their business elsewhere the moment their policy is up for renewal.
So if you are a claims executive running a massive department and you realize that visibility, not speed, is your actual product, what does this mean for how you operate?
It requires a profound paradigm shift, and it is rooted in mathematics, specifically operations management theory. We have to look at Little's Law.
Let's do the math. Break down Little's Law for someone who hasn't taken a systems engineering class.
Little's Law is foundational. It states that L equals lambda multiplied by T.
Yeah, let's translate that.
The inventory of claims currently sitting in your system, that's L, is equal to the arrival rate of new claims, which is lambda multiplied by the average resolution time, which is T.
Got it.
The profound realization here is that the job of a claims executive is not communication. It is queue governance.
Queue governance over communication. Let's map that to a real-world scenario. Think about an airport security line.
A perfect analogy. Imagine a massive holiday weekend. The arrival rate of passengers lambda spikes massively. The time it takes a TSA agent to screen a bag T stays the same, or maybe even lengthens because the agents are stressed and tired. Therefore, the inventory of waiting passengers L, the physical line balloons out the door.
So if the TSA viewed their job purely as communication, they would just hire more people with megaphones to walk up and down the line yelling, "We apologize for the delay. We are working as fast as we can."
Which honestly just makes people more angry.
Makes me furious.
Exactly. Communication without visibility is just noise. But if they view their job as queue governance, they put up digital signs that say, estimated time to security, 45 minutes.
Oh, right.
They govern the expectation of the queue. In insurance, when a catastrophe hits, lambda spikes. Human adjusters are bottlenecks, so T lengthens. If an executive tries to solve this by sending generic "we value your patience" emails, they will drown in angry phone calls. They must build a system where the queue itself is visible. The queue is the product.
But here is the tragic comedy of the situation. To govern a visible queue, you first have to internally agree on what the queue actually is. And the dossier points out this bureaucratic nightmare called consensus theater.
Consensus theater is perhaps the most painful yet accurate observation in the entire deep dive.
It's wild.
The venture-proof analysis details how carriers will routinely spend 8 months and $40,000 on external consultants and facilitators just to get 7 different internal departments to agree on the definition of an open claim.
Wait, 8 months? 240 days just to define the word open. How is that even possible?
It is possible because of siloed organizational structures. To the policy administration team, an open claim is just a newly created digital record.
Okay.
To the billing department, it is a pending financial receivable. To the actuarial team, it is a triangle data point used for future risk modeling. To the legal department, it is a potential liability risk.
So they are fighting entrenched political turf wars over definitions.
Exactly. And while they spend 9 months arguing in conference rooms, the customer is sitting in the quiet middle, entirely ignored.
So as visibility is the actual product and queue governance is the actual job, how on earth does an insurer measure if they're doing it right? Because it sounds like their current dashboards are full of garbage metrics that just track how fast the actuarial team process a record.
You've identified the core operational failure. You must abandon traditional metrics. The industry relies heavily on metrics like cycle times, customer satisfaction scores, CS-stat net promoter scores, NPS, and average handle time, or AHT, in the call centers.
Let's take average handle time as an example. If I'm a call center manager and my bonus is tied to keeping AHT under 4 minutes, my only incentive is to get the customer off the phone as fast as humanly possible. I don't care if I actually solve their problem, I just need them to hang up.
Precisely. All of those legacy metrics are siloed and lagging. A claim can be perfectly on time according to the claims department's internal stopwatch. They moved it from desk A to desk B within 24 hours. They pat themselves on the back.
But that movement might completely violate the policyholder's expectation.
Right. You can close a claim efficiently, but if it took the customer 14 voicemails and 3 live chats to force you to do it, the customer hates you.
So what is the new metric? The manifesto lays it out clearly, and I think it's brilliant. Promise to delivery integrity, or PDI.
PDI is the North Star metric. It is ruthless in its strictness. It requires 3 binary criteria for every single commitment made to a customer.
Lay them out.
Number 1, was it fulfilled by the stated date? Number 2, was it fulfilled on the stated terms, meaning the correct dollar amount and the agreed upon scope of work?
Those first 2 make sense. Did you do what you said when you said you'd do it? But the third one is the absolute kicker.
Number 3, was it proactively confirmed to the customer without them having to call and ask?
If the customer has to pick up the phone to ask you if the check was mailed, you failed the PDI test, even if the check was mailed on time. That is a radically high bar.
It is a radically high bar, and the data reflects that. The venture-proof analysis shows that the industry baseline for PDI is a dismal 45 to 60%.
That means roughly half the time, these multi-billion-dollar corporations are breaking a core promise to their customers.
But consider the immense financial leverage hidden in that failure rate. If a mid-market carrier can achieve just a 25-point lift in PDI, moving from 50% to 75%, the economic unlocking is massive.
Walk us through the financial impact of that 25-point lift.
The dossier calculates that a 25-point lift in PDI eliminates between 400,000 and 600,000 repeat status-seeking phone calls annually.
Just from status calls?
Yes. When you calculate the loaded labor cost of a call center agent handling those inquiries, that unlocks up to $8.4 million in direct operational savings, just from stopping people from calling to ask, "Where is my check?"
$8.4 million straight to the bottom line.
Furthermore, it avoids regulatory fines. State departments of insurance heavily penalize broken commitment patterns. The fines run roughly $12,000 per finding.
Wow.
But most importantly, fixing PDI stops the one-touch churn rate.
One-touch churn, meaning a customer has a policy with you for 10 years, files one claim, has a terrible visibility experience, and immediately leaves.
The data shows that rate sits at 29%. By fixing PDI and providing visibility, you recover up to $2.8 million in retained premium that would have otherwise walked out the door to a competitor at renewal.
Okay, I have to push back here. This is where the visionary in me hits a wall of confusion.
Okay, what is it?
If the return on investment for fixing this PDI metric is a massive 10x to 25x return,
Right.
if it literally saves tens of millions of dollars, what is physically stopping them from doing this tomorrow morning? Why isn't every CEO demanding a PDI dashboard be installed immediately?
Because measuring PDI requires data that crosses enemy lines.
Enemy lines.
Yes. The data lives in disconnected silos that are politically weaponized. Think back to the architecture. The legacy mainframes, the COBOL systems where the financial transaction happens, and the modern CX layers like Salesforce or Zendesk where the customer promise is recorded, they report to entirely different executives.
The chief information officer controls the mainframe, and the chief marketing officer controls Salesforce.
Precisely. To measure PDI, you need the timestamp of the promise from the CRM and the timestamp of the actual fulfillment from the core billing engine. The data exists, but it is never joined.
Why?
Because joining that data creates a definitive record of failure. Each department head would rather hide their own operational defects than expose them to a unified corporate metric. So the broken promises remain hidden, surfacing only months later as customer churn, which the executives then lazily blame on pricing competition or macroeconomic headwinds.
That is wild. It's a massive organizational blind spot masquerading as a technology problem. They are weaponizing data silos for self-preservation. Okay, so we know the new metric, PDI, and we know the root problem, which is siloed data, the visibility lie, and consensus theater.
Yeah.
How do you actually solve it? The manifesto lays out 3 distinct strategic pathways for an executive to fix this without bankrupting the company. Let's dig into those.
Right. The dossier presents paths A, B, and C. Let's analyze path A, which is termed persona expansion.
Persona expansion. When I read this, it felt like the most common bureaucratic reflex. This is where you basically take your existing visibility tools, the broken dashboards you already have, and try to sell the scraps of your current operations to adjacent internal departments, like taking the claims tracking software and selling it to the underwriting team.
It is the path of least resistance. The appeal of Path A to an exhausted executive is that it requires absolutely no new technology. You are simply repackaging what you already own. You convince another department to use your tool, and you declare a synergy victory.
But the dossier gives it a brutal scalability score, a mere 3.8 out of 10. Why is it doomed to fail?
Because it doesn't fix the underlying execution cost. The analysis reveals that under the current legacy system, every manual claim execution, meaning a human looking at a mainframe and typing an update into a portal, costs $5,000 and 1 cent in fully loaded labor and reconciliation overhead.
$5,000 per execution. That is absurd.
Yes. So if you take a highly inefficient manual process and sell it to more people internally, you aren't innovating. You are just multiplying your inefficiency. It buys you some political capital internally because you look like a team player, but it does absolutely nothing to govern the customer's queue.
Okay, so Path A is just shuffling deck chairs on the Titanic. What about Path B, sustaining innovation? Now, this is the one that sounds super sexy to a board of directors right now.
Oh, yeah.
This is where you bolt on AI co-pilots, deploy robotic process automation bots, and use generative AI to summarize claim notes.
Path B is seductive, but it is the most dangerous option presented in the dossier because it looks like a solution while acting as a mathematical trap. To understand why, we have to do a deep dive into the economic concept of elasticity.
This is where the math gets fascinating. Unpack the Jevons paradox for us.
The dossier heavily scrutinizes the Jevons elasticity factor. Through their analysis of claims visibility, they calculate the elasticity factor at E equals 1.02.
Okay, for the non-economists listening, what does E equals 1.02 actually mean in the real world of customer service?
If E is above 1.0, you are caught in a mathematical rebound trap. The Jevons paradox, named after a 19th century economist, states that making a resource cheaper and more efficient doesn't reduce consumption. It actually increases the total consumption of that resource.
Give me an analogy, like adding a lane to a congested highway.
The perfect analogy. The city thinks traffic is terrible. Let's add a 4th lane to the highway to reduce congestion. They spend millions, open the lane, and for 2 weeks, traffic flows smoothly. But because the highway is now faster, people who used to take the train decide to drive. People move further into the suburbs because the commute seems easier. Within a year, the 4-lane highway is just as deadlocked as the 3-lane highway. That is induced demand. That is a Jevons paradox.
So applying that to insurance, if I deploy a fancy AI chatbot to make it incredibly cheap and frictionless for a customer to check their claim status.
The policyholders will simply consume more of it. If checking status required a painful 20-minute phone call, they might only do it once a week. But if you give them a frictionless AI chatbot, they won't just check once, they will check 5 times a day.
Oh, wow.
And because they are interacting more frequently, they will inevitably ask more complex edge case questions that the bot cannot answer.
Like, can the bot authorize a temporary housing stipend?
Exactly. The bot fails and routes the complex question to a human. The volume of inquiries rebounds sublinearly. The AI bot handles the easy questions, but the sheer induced volume of new, complex questions doubles the queue for the human reviewers who have to handle the exceptions.
So your operational savings completely evaporate into the next human bottleneck. You thought you saved money, but you just shifted the traffic jam further down the road.
Path B is not a cure. The dossier calls it a funding bridge.
Explain the concept of a funding bridge. Because if Path B is a mathematical rebound trap, why even bother? I mean, I'd go to the CEO, explain the Jevons paradox, and say we should skip Path B entirely. Why not jump straight to the ultimate solution?
Because organizational reality is rarely that logical. You cannot jump a deeply conservative legacy insurance company straight into a radical future without a bridge.
True.
You need Path B for 2 reasons. First, to habituate the company culture and the policyholders to relying on algorithmic assistance.
Okay.
Second, you need the political capital generated by the short-term, localized cost savings of that chatbot to secure the budget from the CFO. You use the illusion of Path B to fund the massive structural inversion required for Path C.
Ah, you have to feed the beast to slay the beast. You play the corporate game to get the funding. Okay, that brings us to the ultimate solution, Path C. What the analysis calls disruptive vision, or agentic inversion.
This is where the architectural magic happens. Path C abandons the idea of wrapping the mainframe in APIs. Instead, it involves deploying a cloud-native agentic layer that sits horizontally across the entire tech stack. But here is the genius paradigm-shifting part. It only watches the system logs. It is entirely read-only.
Read-only, meaning it has absolutely zero write access. It cannot alter a single piece of data in the mainframe.
Zero write access, which completely bypasses the IT and security deadlocks. You don't need 9 months of SOC2 security reviews to implement a system that physically cannot alter the financial ledgers. It just sits there passively listening to the exhaust fumes of the mainframe.
And what is this agentic layer listening for?
It is programmatically looking for state changes in the data logs. When it sees the mainframe do something, it uses AI to interpret that action. It takes those 40 complex, jargon-filled actuarial codes and automatically collapses them down to 4 simple, binary, customer-facing milestones.
Let me guess. The pizza tracker steps.
Exactly. Filed, in progress, decision pending, resolved.
That is brilliant. Instead of spending millions trying to teach the customer what subrogation review pending third-party validation means, the agentic layer just translates that log entry into decision pending. You subtract the noise, you govern the queue by curating visibility.
And the economic impact of this inversion is staggering. By removing the human from the execution loop, meaning you no longer pay a $60,000 a year employee to manually copy and paste status updates from the mainframe into the Salesforce portal, this agentic layer drives the cost per execution down from $5,001 to the theoretical physics floor of $4.11.
$4.11. From $5,000, that is a 217 times inefficiency gap. That is unbelievable.
It is the only strategic pathway structurally capable of reclaiming that $60 million in operational waste we talked about at the top of the show.
Okay, strategy is beautiful on a whiteboard. But what happens when this agentic inversion actually hits the real world? Because the dossier provides data on this, it recommends implementing an MVPR.
Right, a minimum viable prototype, or as the dossier evocatively calls it, the shadow visibility projection.
Shadow visibility projection. It sounds like something out of a spy novel. They recommend a strict 90-day window for this MVPR. How does it work in practice?
It succeeds because it specifically bypasses what the analysis identifies as the tagging tax.
What exactly is the tagging tax?
In traditional IT modernization projects, carriers start by trying to map their data. They will spend 400 to 500 person-hours having senior systems analysts manually document every single data schema, tagging every field across the mainframe, the CRM, and the billing system to build a master data catalog.
Having built a few basic databases myself, that sounds incredibly tedious and prone to human error.
It is. But worse, the dossier points out that these static catalogs rot within 90 days. Because the moment the CRM team adds a new custom field to Salesforce or the mainframe gets a patch, the master catalog is outdated. The tagging tax kills these projects before they even start.
So how does the shadow visibility projection avoid paying the tax?
By utilizing agentic metadata discovery. Instead of humans mapping the data, the algorithm crawls the data lakes and maps the schemas autonomously in real time. Let's look at the European multi-line carrier case study provided in the text to see the results.
Yes. Let's get into the hard numbers of the real-world application.
In this European case study, they deployed the agentic layer. The algorithm mapped those 40 messy internal codes to the 4 simple customer outcomes, and it did so with 99.2% accuracy, automatically.
That is staggering. 99.2% accuracy without human tagging.
As a result, manual reconciliation, which is the process of humans cross-checking spreadsheets against mainframe screens to figure out what is going on, dropped by 52%.
And how did the policyholders react to finally seeing those 4 simple steps instead of the opaque black box?
Inbound "Where is my claim?" phone calls to the call center plummeted by 80%.
80%. Do you realize what that does to the operating leverage of a massive call center? You've just freed up 80% of your staff's time to actually help people with real problems instead of reading a status off a screen. But here's the part of the case study that genuinely amazes me. It's the death of the consensus theater. The dossier states that the time required for the internal teams to align on status definitions dropped from 9 agonizing months to just 48 hours.
Because the algorithm forces the issue, it doesn't care about departmental politics. It presents the mathematical reality of the data flows, completely bypassing the political turf wars.
It's incredible how an algorithmic watcher can slice through decades of corporate bureaucracy. It just holds up a mirror and says, this is what your data is actually doing.
But we must bring it back to the core operational philosophy. By removing humans from the execution loop, the copying and pasting of updates, and elevating those humans to what the dossier calls human-in-the-loop governance, you actually achieve that $4.11 execution cost.
That distinction is crucial. Let's make sure we clearly define the difference between execution and governance here.
Execution is mechanical. It is typing a status update into a portal. It is reading a mainframe screen and pasting it into an email. It is manual, slow, highly prone to error, and incredibly expensive.
Right.
Governance is entirely different. Governance is an experienced adjuster looking at a dashboard of algorithmic predictions and only intervening when the algorithm flags a complex anomaly. The agentic layer executes 85% of the routine updates instantly. The human expert governs the 15% exception queue. That is the structural inversion.
That makes so much sense. You stop paying experts to do data entry, and you start paying them to actually use their judgment. Okay, we are coming to the final implications of this dossier. We've talked about the tech, the math, and the strategy. But where does this structural paradigm shift ultimately lead the industry? What is the future of customer experience in insurance?
The manifesto describes this necessary evolution as the transition from an era of information decay to the era of the transparent carrier.
The transparent carrier, I like the sound of that.
It represents a fundamental flip in the business model. Visibility transforms from being a massive, resented call center expense into a highly monetizable retention asset. Think about it. When you are the only carrier in the market that actually tells the truth about where a claim is in real time, that transparency becomes your defensive moat.
And it's a permanent moat, because competitors can't just buy an off-the-shelf chatbot to catch up.
Exactly. A conversational AI chatbot layered on top of broken COBOL architecture is still fundamentally broken. To catch up to the transparent carrier, competitors have to structurally re-architect their labor stack, break down their deep-seated data silos, and overcome their own political governance issues. That isn't a software purchase. That takes years of painful organizational change.
Here's where the vision gets genuinely exciting, looking toward the horizon. The dossier outlines the concept of the portable data token. It imagines a future where the status of your claim isn't even locked inside the carrier's proprietary clunky web portal anymore.
Right. The friction of forcing a policyholder to remember a password, log into your specific app, and navigate a dashboard is eliminated. Instead, the transparent carrier broadcasts the raw claim milestones directly to a policyholder's digital wallet or their personal finance app.
Like Apple Wallet or Mint. Imagine that. You get into a fender bender, you file the claim, and you don't interact with the insurer's app ever again. You just get a seamless push notification on your phone's native wallet saying, insurance payout approved, funds arriving in 2 hours.
Yeah.
It treats the customer's data as belonging to the customer, not the corporation. And by automating the tracking, you delete the internal audit artifact requirement, where the adjuster has to waste time logging every move they make just to prove they did it for compliance. The system moves from reporting on the work to the work is the report.
It is an incredibly elegant, frictionless vision. But as the pragmatist, I have to ground this flight of fancy. At the end of the day, before anyone gets to build portable digital tokens for Apple Wallet, this is about baseline financial survival.
We have to return to the numbers.
Yes, we have to return to the numbers that started this discussion. This is about reclaiming the $495 million in relationship value that is currently walking out the door due to churn. And it is about stopping the $60 million in direct operational waste that is vaporizing on manual reconciliation and call center bloat. If carriers don't fix the fundamental queue governance now, they will not survive long enough to see the era of digital wallets.
That is the sobering reality. The technology to fix it exists, but the organizational will has to catch up. Let's wrap this up. Thank you, everyone, for joining us on this incredibly dense, fascinating journey into the hidden mechanics of trust, queue governance, and the visibility lie. We've gone from ancient COBOL mainframes translating data at the castle gates to the Jevons paradox, all the way to agentic log watchers.
And I want to leave you, the listener, with a final lingering question that builds on the profound themes of the venture-proof analysis. We just spent an hour dissecting how a heavily regulated multi-billion-dollar industry is hiding a 12,217 times inefficiency gap simply because they failed to map their internal reality to their customers' belief.
Right.
So look inward. Where is the visibility lie hiding in your organization? When your customers are waiting in the quiet middle, are you actually governing your queue, or are you just sending out better, more politely worded apologies?
The dashboard might be green, but the building might still be on fire. It's time we stop pretending we can't see the smoke. Thanks for listening to this deep dive. Keep questioning the queue.